Hi, this is Drew Tignanelli. This is our April 2023. Fortunately, Mike, only 14, 18 days left in this tax season as we record this. I think Leo told me today it's exactly 19 days, but it's been great. I
What are you going
loved
to do
it.
with your evenings and weekends after this?
I love it. I enjoy looking at tax returns and saying to people, if we do this, we can lower this, we can lower, because the tax laws are just ridiculous,
They are.
just downright ridiculous. That if you don't understand where these different breakpoints are, you could be hurting yourself thousands of dollars just because you made $500 too much and didn't realize that you did it.
Yeah.
So anyway, I enjoy it. So
I think
fortunately, this tax season will be coming to an end soon.
it's always this time of year that I realize that for our clients, especially things like taxes, because they're so complicated and because they seem so unfair. How could I have gotten money back this last year and owed this year? I didn't make that much more. All those things that you're talking about. And the one thing that I will say I take some fulfillment in is being able to walk clients through. Well, let's help you better understand how the tax code works. You
Yeah.
know, I would venture to say half of all people or more don't even understand what a progressive tax system is. So anyway, it's an exciting time for accounting dorks like us, right?
Well, it's the time of the year that we, over and above, accomplish our mission of helping to lessen the worry and burden of money management, because we take that very seriously.
Yep.
And if we're not doing it during tax time, there's something wrong, because the burden of taxation is onerous, to say the least. Anyway,
Absolutely.
let's go to the other thing that clients are worried about, which is markets and stock markets and
Sure.
bond markets. And they keep reading all these media is just pounding the drum about how awful the world is and how the markets are going to crash in a week, in a day, in an hour. They've been saying that for 6 months, that you're going to have this incredible crash. Somebody's hoping to become a hero in a month or 2 or 6 months. And if it never happens, then they just wait for the next opportunity to say it.
The broken clock, right?
The broken
Correct
clock
twice
is
a
all
day.
right, twice a day. And I'm not saying that the markets couldn't go down. They very could. I can make a good argument for the negative scenario. I can make a good argument for the positive scenario. The funny thing is, Mike, that I've learned in 45 years of doing this, that great predictions are always done once. Elaine Gazzarelli, she supposedly predicted the crash of 1987 and then disappeared in obscurity. I remember when I first got into business, there was a guy, and I wish I had Chris here. He could remind me all these people's
Oh yeah.
names, and that he hit like 3 times. He said the market's going down or going up, and it happened. And then he disappeared into obscurity. And there was a Merrill Lynch guy who was like the guru of when markets are going to be good or markets were going to be bad. And then he disappeared into obscurity. And the list goes on. And Drew Tignanelli, I can prove that I told people in 1987 that the market was going to drop 500 points in one day, okay? In one day. And it was June of 1987 that I said that. And later on in in September of 87, it did it. But the funny thing was, when I said that, I said it would happen in 1988. I didn't say it was happening in 1987. And I also realized that I was also just a one-time wizard. I made one great prediction, and then I disappeared. My predictions disappeared into obscurity. And I had to learn that over time, that people make predictions and they come true, but it doesn't mean they understand anything. It just means that they made a prediction and coincidentally it came true. That's what the markets are all about.
So let's talk about some of the big stories that are out there in the media right now about the markets. At the time we're shooting this, we've just come off of an interesting set of weeks of dealing with banking news. As Drew said at the beginning, a lot of big words get used by news resources and things like that, calling things a crisis and things like that. The banking situation is a situation. It's definitely something that, Drew, as you've said, the banks are going to have to work out, what they're going to do, since they've been paying everybody nothing for so many years. And now all of a sudden everybody's got better options.
It was an anomaly, Mike, that you could have a savings account at a brick and mortar bank like Bank of America or PNC or whatever, paying 0.01%. That's literally nothing. And yet you could go to the same FDIC insured institution like an online savings account and get 3-4% rate of return, and people weren't moving their money quickly to that option. And it was an anomaly. But now all of a sudden, the momentum has picked up. And in the last 6 months, people have said, oh, wow, I could get 3 or 4%, even though you and I have been saying this for years. All of a sudden, the public has picked up on, I can get an FDIC insured account yielding 4%. So what's happening is money is fleeing the banks that are paying them nothing and going to these others. Now, the banks have to deal with that. They have to be prepared to allow that money to flow out the door. But remember, the banks also, they lend money to businesses and real estate
government
and the federal government for longer periods of time, because they want to get a higher rate of return than what they're paying their depositors. Well, if those depositors keep coming and asking for money, there's only a certain pool of money that they have to be able to liquidate to those people asking to leave.
Sure.
And they have to constantly be figuring out how to bring more money down and make it available to people wanting to get higher rates of return. Or they have to raise their rates of return, right, to stop the people from leaving. And if they do that, they're going to crush their earnings. But it's better that than losing the deposits, right? And so that's what's happening. You're having this issue, like you called it. I wouldn't call it a crisis. I would call it a serious issue where the banks are massaging themselves to work out what's happening. And they're probably going to see their earnings decline. But this is nothing like 2008, Mike.
Right.
In 2008, the banks were investing in worthless. Did you hear that word? That means zero. That didn't mean that they were just losing deposits and so forth. They had put their deposits into worthless securities, and they were absolutely bankrupt, and the government came in and made an equity infusion into the bank. It was called the TARP, and the banks were able to use that to recapitalize themselves and get back into business, right? This is a very different scenario. Higher interest rates cause flee of money. It causes you to not make as much money on your money. And if you don't do it right, like Silicon Valley Bank, you're going to go under.
Right.
Okay.
So earlier this month, we already put out an email with an update on the banks that you all should have got that goes into great detail on that. But at the time we're shooting this video, it's only been a handful of banks that have had outsized risk that are in the thick of the situation. And at the moment, again, time of we're shooting this on March 29th, markets seem to have built in some level of confidence that the system will work its way through it. For us internally here, as many of you will see if you come into our offices or if you look at our team page, we have a lot of young team members here. And I took great enjoyment in forcing them all to watch the bank run section of It's a Wonderful Life a week ago to help illustrate that. What'd you say, Drew?
With Jimmy Stewart.
Jimmy Stewart. I don't know all the actors' names. I was not quite alive.
Classic. That's where Jimmy Stewart got his start. Is It's a Wonderful Life, and and he was a banker, and it was the Great Depression, and there was a run on the bank, and he had to survive the run on the bank, and he did.
And like anything else that's ever been recorded, you can find it on YouTube.
Yeah, that's true.
So also, since our last video, we had another Fed meeting, the March Fed meeting, where they decided to increase rates another 0.25%. While they raised rates again, right in the face of the banking issues, Jerome Powell did kind of signal that he was getting ready to lighten or maybe not go as high going forward.
Yeah, but you know, the Federal Reserve proven they don't know what they're talking about. He might sit there and says, "Oh, Drew, do you have to say those kind of things?" But you know, they were the same group that said
we'll throw in your application for Federal Reserve Chairman.
They were the same group that said there was no inflation. We're not worried about it. Now they're the same group saying there's so much inflation that we have to totally obliterate it, and there will never be inflation again once we're done with it. And if they keep doing what they're doing, they might be right. But I'm assuming that they're going to come to their senses sooner or later and come to a more logical conclusion. But anyway, what's
so on the whole video today has a theme of interest rates. So in our last video, we talked about Flourish, a new offering of high yield savings accounts.
So we're part of the problem.
Yes, we are. We are that kind of grumpy old guy who's taking his money over to not Mr. Bailey, the other guy. Anyway, so we've been encouraging clients, whether it be to Flourish, that we're now able to kind of help you set up, or to places we've referred to before, Marcus Bank or Ally Bank or American Express Savings. There's a lot of higher interest rate products out there. Flourish has been an extra added bonus because not only does it have higher FDIC insurance, it's got even higher rates as of the moment. And just in the 1 month since we've introduced it, as of April 17th of this month, will be increasing individual accounts to $1.5 million of FDIC insurance, joint accounts to $3 million, and business accounts and organizations like nonprofits to $1.5 million. And the rate on the first 250 or 500, depending on account type, it's gone to 4.4%, and the remaining is at 4%. So still a great option. You can talk to your advisor if
and I would add to that, Mike, that any of our clients that we told to go to Ally Bank or Marcus or Discover or My Savings Direct or any of those banks, they ought to close those accounts and go to Flourish. And the reason is they've got higher insurance, they've got a higher rate of return, and they have the ability to allow us to see it with them. And we don't charge anything on the Flourish money, but we can see it. And if there's a problem, we can also intercede and help to rectify any problems. Those are great reasons that there's no benefit to being with Ally or Marcus now that we have this opportunity.
Well, let me qualify. And I think when Drew says that, he means up to the FDIC insurance level. We do have a number of clients that are using 4 or 5 of those banks because they really like cash.
Oh, okay. Yeah, well, you can qualify that if somebody's got married more than $3 million of cash, then that 1 or 2 clients that we might have that situation, then I would say, yeah, then Flourish isn't going to work for them. But Flourish uses a multitude of banks to help increase that limit. But I don't see the benefit for most of our clients for using Ally or Marcus or anything. So they should call their advisor and get an application and move all that stuff to Flourish.
So speaking of why those accounts exist, one of the things in our financial planning discussions that we have with clients is often the emergency savings account, the emergency fund. And that's a perfect item to use for your high yield online savings account. But you know, how much should you have and who needs it? I'm going to say that it's especially important to encourage anyone in your household or your family that has less assets, especially those kind of getting started off. There is a huge correlation to long-term financial success and those who build that initial little chunk of money to handle any emergency so they don't get into the debt snowball that I will bring back in a moment. We've always said, hey, if it's a 2-income household, you want to have, 25,000 for, for each spouse that you need to replace a income for, or I'm sorry, 25,000 if you've got 2 incomes, 50,000 if you've got 1 income has kind of been our baseline, but for everybody, it's going to be
I think you said that backwards. If you have
I
two
said it
incomes,
backwards the first time. I said it
you have
correctly
two
the second
incomes.
time.
If you have 2 incomes, you want $50,000.
Right.
If you have 1 income, you want 25,000.
No, I said it correctly the second time. So if they have 2 incomes, they can have 25,000 because the chances of both of them losing their jobs is lower.
Oh, I see what you're saying.
Yeah.
But okay, but
if they're a single person, yes, 25,000 is fine. But if
okay,
you're a married couple, like
I hear what you're saying. What Mike's trying to point out is that if you have 2 incomes, you're probably only going to see one spouse lose their income. So 25,000 will be more than enough to deal with that. But because the other spouse still has income coming in, right?
Right.
If you have 1 income and you lose it, now you have nothing coming in, and you need 50,000 to be able to deal with that until you can replace it. That's what you're saying.
Right. And,
okay. Well, that's a little different than what I was thinking,
This is your advice that I'm repeating.
Hey, my advice. I like to just say 25 to 50,000 period. It's choose your amount of emergency money, but then you need to also know that there's a portion of your investments that are relatively liquid at all times.
Yeah. So the last of the financial planning topics is Drew and I both had scenarios over the past month where we saw people handling debt in a way that we wouldn't advise. And in my scenario, I ran into a household where they were very happily double paying their car payment that had a 2% interest rate, but underpaying or paying the minimum on a mortgage or a home equity line of credit that was at 6.5%. And I said that I would come back to snowballs a little earlier. There's a very famous financial pundit, I don't know what you would call him, Dave Ramsey. Pundit. Should have stayed in school, Drew. I should have.
You and me both. I do that all the time. Make up my own words.
Yep. That's good. It's always fun. It adds flavor to the to the communications. But
gives people like my wife something to talk about me about.
Yeah. So anyway, he wrote a book called Debt Snowball, which kind of focuses on paying off the smallest debts first to get yourself to be debt free. There's an argument to be made for it, but unless you're in kind of a really significant psychological space of problem with debt, if everything is otherwise going okay, always want to make sure you pay higher interest rate debt before you pay lower interest rate debt.
Unless the lower interest rate debt is so small a balance that you can get it paid off really quickly.
And you just have one less thing to deal with.
I would kind of agree with that, because now you can focus that cash flow onto the other one immediately. But if they're going to both be paid down at about the same rate, I would pay the higher interest rate with you. I'd be with you. Right. But I had one, Mike, where somebody had like $200,000-$300,000 in the bank, earning 2-3%. So they were using online savings accounts, but they also were carrying a home equity credit line with about $40,000 of cash on it at 7%. And psychologically, it was logical why they were doing what they were doing. Economically, it didn't make any sense. And so I had to work at breaking down the psychological to get them to appreciate the economical and move on to a better financial situation. Yeah. Everybody, like I like to say, Mike, the way you think about money is going to determine everything you're going to do with and for money. And as a financial advisor, we have to appreciate what our clients are thinking about before we pontificate on the wonderful economic wisdom that we have, but we're never going to get them to change what they're doing that we would not necessarily agree with, because there are times when what they're thinking about actually works out better for them, even though it's not economically perfect, it still makes sense. And so it's always good for us to understand what a client's thinking about before we ask them to make a change to something that's economically different.
Yep.
So,
Well, and before we wrap up, let's just give one more reminder that Financial Physical, the book, is out and it's on Amazon.
you can see it back there with Chuck, you know.
Hell, he's got good companies sitting there right next to Chuck, and we've got plenty of copies of the book in our offices. So if you stop by one of our offices, feel free to ask. But if you would rather have one shipped, we priced it as inexpensively as possible, $5.99 direct, shipped free from Amazon online.
$2.99 on an ebook version.
Yep, absolutely.
So yeah, we priced it. I mean, normally you're supposed to make it $19.99 and $9.99, and we said no. We want people to read it. We're not looking to make money out of the book. We want people to read it. We want people to share it with others and understand that this industry, which is incredibly sales focused, needs to become professionally focused. And unless the public demands it, the industry will not change. And so it's about why the medical profession, a general practitioner of medicine, is a great model for how financial advisors ought to operate. And it's my life story about how I got here today. So, and there's also at the end of each chapter, there are great tips on financial planning. So there's like 30 different tips in there that everyone should understand about personal finances. Anyway, I think we're finished, Mike.
I think so.
This is Drew Tignanelli saying God bless.